Good morning, and thank you for being here for the Hedge Investment Credit Fund monthly update for April. April was a very strong month for us. We were up a little bit less than 3%, predominantly driven by macro shorts. Our big conviction macro shorts remain China on one side, and then fixed income, and within that, European credit spreads. China, we articulate that short through the Chinese renminbi against dollar, financial subs of banks exposed to China, and then Chinese credit default swaps. We remain quite bearish in China. We think there's a very serious housing crisis, probably equivalent, if not worse, than subprime in US. We think there's a political crisis coming up with a lot of tension at the Politburo level for the re-election of Xi Jinping towards the end of the year. And then thirdly, we have this big issue of COVID with the breakdown again there of the system, various lockdown being imposed. Obviously, there is a big gap between the vaccination status of the Western world and China. So China is something we remain particularly bearish. We will trade around, but the view is bearish. The second big driver has been, European credit spread, anywhere from France to Portugal to Greece. We think the QT will come. We think QE will be stopped within the central bank in Europe wants to raise rates. We think inflation is going to be quite stubborn. More importantly, we think the biggest problem in Europe remains the core. We have Germany, which has been overvalued for decades. We've been saying that to investors for a long time. Now, all the weaknesses in Germany are becoming very, very apparent. It's a country that doesn't have a military status, doesn't have a proper defense system, and we are in the middle of a dangerous and expansion in Russia. So Germany will have to spend a lot of money on arms going forward. It's a weak government, it's not the Merkel-Schäuble kind of combination we're used to. And then thirdly, the exposure to energy, gas, and complete removal of nuclear powers from the country. The idea of pricing German Bund as an embedded call option Deutschmark is over, is finished. Germany cannot walk away from the current predicament, and that is bad for the pricing of any credit spread in Europe and any assets in Europe. Secondly, we have France, which is the other pillar of the core. Big problem there is energy again, this time different thing. Nuclear is problematic in France. There's been a lot of issues. EDF has been short for us this year, and we still think the situation there on the nuclear energy front is quite worrying. There's a lot of issues, and it could be that we go to a situation where the energy supply is quite under pressure. So overall, quite negative on those drivers. Plenty of special situation. We go long and short. We start adding to a lot of situation of stress, distress, which we think are totally mispriced for the fundamentals, but obviously we need to be prepared for volatility. Overall, remain of the same opinion. I think most assets, financial assets, will have negative returns this year. We think we are getting into a very dangerous situation where individuals and companies will have to switch out of financial investments affected by deflation to then be able to buy goods and services in the real economy, this time affected by inflation. With this, I conclude, and I hope we can talk for next month. Thank you.